Picking the right time to buy or sell your stocks is a bit like picking the perfect melon. As there are indicators to suggest whether a melon is ripe or not, investors look at market indicators to help form more informed decisions with their securities. Welcome to dooacademy. Today, we'll get to know a few market indicators and case studies that demonstrate how indicators influence market movement and trends. Now there are two types of market analysis: fundamental analysis and technical analysis. Technical analysis is used more in the review of short-term investment decisions and involves past data and statistical trends in the stock's price and volume. Fundamental analysis considers both past and present data about a stock, measures the intrinsic value of a security, and is most often used in determining the quality of long-term investments. While technical analysis is based on charts with price movements, fundamental analysis is based on studying financial statements and economic news, tracking trends, and understanding economic sentiments. This is where indicators come into play. Economic data such as GDP, shopping activity, jobs, and potential interest rate shifts are all important indicators in fundamental analysis to predict market trends and changes. Imagine a party where someone suddenly bursts out singing. Market indicators are like that surprise singer, they set the mood. Some can even flip the script, turning happy tunes into sad ones. Market indicators are typically analyzed from four key categories of a country, which are employment, inflation, consumer activity, and investor activity. So how exactly do indicators work? Let's take the well-used inflation indicator, the CPI, for example. The Consumer Price Index, or CPI, measures the monthly change in prices paid by consumers and is one of the most popular measures of inflation and deflation. When it comes to CPI, a moderate increase in prices is favorable. When prices go up a little bit each year, it shows that the economy is doing well. If prices go up too much or don't go up at all, it can cause problems for people and businesses. The US targets an inflation rate of 2% to represent a healthy, growing economy. If inflation is too high, the consumer's purchasing decreases, which usually leads the US Federal Reserve to raise interest rates to slow down the economy. On the flip side, if there is deflation, the economy is considered weak, and this usually leads to the Fed lowering interest rates to boost the economy. Now, the CPI in the US for June 2023 was 3%, which was its lowest level since March 2021. With the lower inflation index, the market expected the Fed to slow the pace of interest rate hikes, which leads to quite predictable outcomes in US stocks. Lower interest rates mean reduced borrowing costs for companies, which can lead to higher profits and increased investment. This positive environment often attracts investors to the stock market, driving up stock prices. Thanks to June's CPI, US stocks opened higher, with the S&P 500 up by 0.86%, Nasdaq 100 by 1.11%. US dollar. When US interest rates are not rising quickly, the attractiveness of the US dollar as an investment option may reduce. This can lead to investors seeking higher yields in other currencies. With June's CPI, the dollar crashed to its lowest in more than a year since April 2022. Gold and alternative assets. Lower interest rates can reduce the opportunity cost of holding assets like gold, which may lead to an increase in its demand. When consumer prices cooled more than expected in June, gold prices rallied and rose 1.1%, on pace for the largest daily percentage gain in about 6 weeks. While indicators are useful in helping predict market movement, you must remember that there are still many variables in play. Sometimes a forecast may hit a slam dunk, and sometimes it may miss the shot, leading to more volatile markets. Let's look at some examples. The Purchasing Managers' Index, or PMI, is an index that measures the monthly change in economic activity within the manufacturing sector. It's a key economic tool and is among the most reliable leading indicators of the US economy, which tells us if businesses are doing good or otherwise. If the PMI is over 50 in a given month, it's like a happy green light to indicate that the economy is expanding and seen as a bullish signal. If it's under 50, it's like a gloomy red light and a general indication that the economy is contracting. In January 2023, ISM Services PMI rebounded to 55.2, which is 6 points higher than the December reading of 49.2% and better than the market expectation of 50.4. The strong data drove the dollar higher to a 1.05% rise on the day at 102.78. When actual performance exceeds indicator expectations, it's definitely a good day in the market. In the United States, the ADP National Employment Report and non-farm payrolls reports are important indicators to understanding the job market in the country. The ADP report is like a sneak peek into the private sector jobs scene by getting a forecast about who's hiring and who's not before everyone else. This early insight helps investors predict the overall job market trend. The US non-farm payrolls or NFP, on the other hand, shows the number of jobs added in the US, except for those in farming, government, private households and non-profit organizations. Both of these reports are crucial because jobs impact the economy's health. If people are working, they are spending, and that can drive the economy forward. If jobs are struggling, it might signal economic trouble. In essence, when the number is high, it's like a thumbs up for the US dollar, and when it's low, it's like a thumbs down. Now, what happens when the forecast and actual numbers don't match? In early June 2023, the US ADP report announced a whopping 497,000 new jobs. This gave the impression that the job market was hot. However, when the official data came out from NFP, it showed only 209,000 new jobs, which was significantly lower than predicted. This caused a stir because it hinted at potential changes in the economy and even affected the value of the US dollar, which took a dip. When forecasts miss their targets, it can send ripples through the market, making investors reevaluate their strategies based on real-time job data. Market indicators are the essential tools that guide traders and investors through the intricacies of finance, offering insights into trends, risks, and opportunities. By distilling data into actionable insights, they empower informed decision-making, crucial for navigating an unpredictable market. So, have market indicators been instrumental in shaping your trading or investment strategies? Share your thoughts in the comments below. Be sure to like, share, and follow dooacademy for more actionable investment insights.